Hello and welcome to the FinanceFeeds podcast series. And today on episode number 6, I'm joined by Jeff Wilkins, who is Managing Director of Think Liquidity in Grand Rapids, Michigan. Hello, Jeff.
Hi, Andrew. Thanks for having me on today.
Great pleasure. Nice to speak to you as always.
Yeah, great speaking to you.
We've got some really interesting subjects today to speak about. And Jeff, just so for those who are listening, Jeff is a real expert in risk management and the technology that actually is used to provide risk management solutions. And he's actually a very well-known industry figure in this particular sector. So I gather, Jeff, you've got some specific issues about the certain new regulations that have been passed in Australia, as well as some trading platform matters that are poignant at the moment.
Yeah, I think an interesting topic that we should touch on today would be the client money rules that have recently passed in Australia. And really it comes down to, I guess, the use of client capital for hedging, and that's going away. It's going to have to be operational capital moving forward.
Yes, indeed, and I gather that was implemented. That's now in the process of being implemented. And actually, as far as I understand, brokers, retail forex brokers and OTC derivative brokers in Australia with an ASIC license are not allowed to actually use client funds for the purposes of hedging. They have to actually have their own capital and put that up. Am I right?
Yeah, that's exactly right. And I think ASIC has done a good job. They've implemented a 1-year grace period. Yes. It's a big change. I think it's an appropriate change, but it's not something that you can do overnight. You know, if a broker's got $20 million in client capital, and let's say they've got $3 million on their balance sheet, there's a big change coming down the pipe. So they can't use that client capital for hedging. So they're going to have to figure out a way to take risk and figure out a way to take appropriate risk. So it's something that may be new for these brokers that have been maybe more of an agency broker in the past. So it's going to change a lot of things in Australia and the way that brokers are handling risk management moving forward. I
think that's absolutely right. It does mean another aspect, and I totally agree with you that actually the Australian Securities Investment Commission, the ASIC, has over the last few years made tremendous steps towards becoming a very sophisticated regulator. And they've actually got some regulatory technology on board which conducts real-time surveillance on brokerages, and they are really astute. They understand the electronic trading industry very, very well, which has led to Australia being a very good region, a very well-organised jurisdiction for this business. However, and I think obviously going ahead this is a good thing in terms of the way that the regulator has designated client capital can't be used for this purpose. However, do you think that it might cause some of the smaller brokers that want to start up, and I know that ASIC has been recalcitrant over giving new licenses to smaller brokers, but do you think that this might cause smaller brokers to find it not so viable to set up in Australia, and large brokers, which are companies like AxiTrader, which is now expanding very well under its new management, Rajesh Yochanan has taken venture capital and wants to expand the company, and you have Australian branches of other companies like CMC Markets and so forth in Australia, Saxon Markets, will have an advantage for them compared to smaller brokers?
Yeah, I definitely do. I mean, the fact that you're going to need a hefty balance sheet in terms of hedging client flow, it's going to change things. So, you know, if you look at a small broker versus a large broker, the large broker has the balance sheet on their side. They're able to also have diversity of flow, so taking risk is a little bit easier. Whereas a small broker, they may not have as diverse of flow. So, you know, one day or 2 bad days could ruin their entire month. So it's very important that these small brokers, you know, if they do want to start up in Australia, they've got to have a 100% proper handle on risk management. And, you know, that's not just looking at A book and B book. That's looking at who you're using for liquidity. That's looking at leverage restrictions that you have in place, limits on positions that you're willing to carry. I can list about 20 things that they need to be doing, but unfortunately a lot of these brokers are just looking at who's making money and who's losing money and segregating their A book and B book that way. So it's unfortunate that that's the way it currently is, but I think it will change, especially given this 1-year grace period. It will give these brokers an opportunity to figure it out. But the large brokers, what we're also seeing is interesting. I can't name one of the large brokers in Australia outside of, I can think of one that hasn't already expanded overseas. So FCA, also looking at some offshore jurisdictions to put some other flows. So there's a lot of stuff going on in Australia, and it's a fluid market, but we're seeing the large players there expanding globally now.
That's right. It's understandable why. It's the gateway to the Asia Pacific region. It's a very well structured business environment, very good quality. There is not a track record of poor quality companies that don't stick to the regulations, and ASIC has actually made a good effort at maintaining that. But I think it could be viewed that they are emulating in a way the North American system, the NFA, in respect that there is a very stringent reporting process where brokers have to report regularly, and they're using surveillance systems. And also, if you want to be a brokerage in the US, I made the point recently that about 5 years ago or so, many non-American brokers who had branches in America and some business in America pulled out of the US market, saying it wasn't viable. But actually what's happened is that those domestic firms like FXCM, Gain Capital, Interactive Brokers, Aranda Corporation, the good, large, evergreen American brokers, are going from strength to strength, and they're managing to navigate the NFA rules with ease. Whereas many of the companies that pulled out of the US market, like IBFX, like ILQ, like Alpari UK, which had a US division, don't exist anymore even anywhere in the world, let alone in the US. So it says something about the structure of the market, which is something which causes sustainability. So therefore, by making companies use their own capital to actually put down as hedging, it could be Australia's version of the $20 million regulatory capital that's needed in America, and therefore encourage the stable companies to stay in business.
Yeah, Andrew, you hit the nail on the head. I mean, a funny story about this surveillance in the U.S. when the NFA was implementing that. I'm in Grand Rapids. Chicago's about a 3-hour drive.
Yes.
I went back and forth between Chicago and Grand Rapids to work with them to implement their surveillance rules. At the time, I was running risk for one of the larger brokers in the U.S., and we were viewed as one of the better players in the U.S., probably the cleanest player in the U.S. at the time in terms of regulatory track record. So I worked on the surveillance with them, and it was a tough rule because not only was it expensive for brokers to pay for transactions that needed to be monitored and submit everything every day and drop everything to get this project complete, but what I found was once it was implemented, every day I would walk into the office and there would be 5 or 6 trades that I got from the NFA saying, these were outside of the thresholds, please come back to us with what happened.
Yes.
So it was a really, really positive outcome for the actual consumers, and it was annoying for brokers. I guarantee it was annoying for every single broker that had to do it, but it made an off-exchange market very transparent and clean.
Yes, it did. Yes, it did. That's right.
Yeah. And I think you also hit the nail on the head with they've got the $20 million rule in the U.S. This isn't necessarily the $20 million rule in Australia, but it makes sure that brokers have proper capital to operate. But the one thing I think is missing is going to be the ability for these brokers to manage risk properly. There needs to be some type of restriction or visibility into how they're managing those risks. My concern is that this is just going to force brokers into de-booking everything and closing their eyes and hoping for the best.
It's possible. I mean, there could be a possibility that some of them, especially the larger, more organised ones that have very good operations teams and very good proprietary technology, like in the case of Saxo Bank or CMC Bank, have their own technology, their own platforms. They could, in some respects, outsource the risk management to a specific specialist to actually run their book for them to a certain extent. Yeah,
definitely. And that's really where Think Liquidity comes in. we've got an internal team that helps brokers overcome these challenges, and we've recently taken all of our internal tools and we've created a product called QuantView. Now, QuantView on its surface is you could view it as a reporting tool or a risk management tool that shows position, shows data. Everyone and their brother on the market has a reporting tool at this point. But what we've done is we've created a scoring mechanism, and we actually apply a scoring algorithm to every single transaction that happens during the lifetime of a trader's trading history. And what we found is that scoring mechanism, after about 25 trades, we can fairly definitively say a trader fits a certain profile, and those scores don't change. And so once we realized that internally, we started using those tools more and more. And as we saw success, we actually went to the U.S. Patent Office and got this product patent pending.
I see.
And so, yeah. We're pretty excited about that. We received that about a month ago.
Nice. So that is interesting. When do you think it might be launched?
We're in the process of launching it right now. We weren't allowed to talk about it until we received that patent registration number.
Right.
We finally received it. So we're starting to roll it out right now, and the uptake in the market's been incredible.
Right. That's interesting.
It's similar tools that a bank's going to be using internally. They look at the first millisecond, 5 milliseconds, 2 seconds of a trade. The brokers have the luxury of seeing the lifetime of a transaction. So, we're applying decay analysis across the entire lifetime, and it works.
Yes. So, yeah, indeed. That is excellent. Indeed, that is very nice. I shall be following the progress of that, and very much look forward to seeing that in live action. Yeah,
we appreciate it. We're excited about it, and we're excited to put these powerful tools in the hands of brokers. And it takes us a couple hours to get them up and running and show them how everything works once we launch, and the ROI is within minutes. You can start generating returns with the product.
Very interesting indeed. And that kind of technological lead in terms of retail access to the markets leads us on to another subject, which I know that you're you've got a very poignant perspective on this, is the sudden upsurge in popularity after all this time of MetaTrader 5.
Yeah, MT5. Geez, how long have we been hearing about MT5?
Six years or so by now. It must be 2010, I'm sure.
Yeah, and I think you're starting to see MetaQuotes forcing their hand now. And they really can force their will and force their hand on the market because they've got the market cornered. It's going to be interesting how things turn out. I mean, did you see, Andrew, I think it was 2 weeks ago, MetaQuotes increased their license fees on MT4?
Yes, indeed I did. And I think that this is the point now, is that certain integration software and the way that the new type of market connectivity systems that now are compatible with MT5 are allowing brokerages to reduce their operating costs, especially if they've got more than one office. Let's say you're a British or American brokerage or Canadian brokerage and you've got an MT4 server. That means you want to go to Hong Kong, you have to have another server farm in Hong Kong. It's another $100,000. You have another one in Canada, it's another $100,000. MT5, you host the whole thing on one server and you just have terminals all over the world.
Yeah, and I think there's a handful of us in the market that are proper bridge providers for these platforms. I still think that it won't be MetaQuotes, it won't be the brokers, but it'll be the retail traders who end up making the decision as far as the uptake of MT5.
Yes, probably.
But MetaQuotes really forcing their will on these brokers to buy the platform and start offering it will encourage the retail traders to make a transition. I think MT5 as a product, it's still going to go through some growth and release cycles. There's lots of platforms on the market right now, and MT5 is a multi-asset platform, but there's things that need to improve, and you've seen it through continuous releases from MetaQuotes. So they'll get there. I think it'll be this year that you start to see probably towards the end of the year, the real uptake.
Yeah, that's right. I think so too, and I think that there's been this is something that's gone unnoticed to some extent. But everybody, when you talk about exchange traded retail assets, think about Chicago. Think about CME, ICE, Nasdaq, all the Chicago-based electronic exchanges, which cost a fortune. You want to be an exchange clearing member; it'll cost you $500,000 per year, and then you have to pay all the membership fees and so forth. If you're an OTC trader or an OTC brokerage, you can't. It's just not viable. Whereas MT5 has been connecting itself to up-and-coming exchanges in other regions, like in the Middle East. You have the DGCX, the Dubai Gold and Commodities Exchange, where the Indian rupee contract is a futures contract traded electronically on that exchange. Very minimal fees. MT5 there's now 10 brokerages using MT5 on that particular exchange. So I wonder whether there's a possibility for well risk-managed connectivity to other venues and doing exchange-traded multi-asset. It doesn't have to be FX, it could be stock or commodities via the MT5 platform, connected through venues using a specific risk management platform.
Yeah, certainly. And the interesting thing about multi-asset is you can manage FX and most CFDs in a similar way, but when you start to get into the world of futures or stocks, it's a completely different animal. It's a completely different ballgame.
Yes.
So these brokers that need to make that transition or add these new products to attract new flow, they need to understand that you don't want to be on the other side of stock trading for the most part. You know, if you're seeing stocks that move 10% a day, it's going to be a lot different than a currency that typically moves maybe 1% on a decent day, maybe 2%, but that's a massive day. So
that's true. That's right.
And the other thing about stocks is everyone's long. You know, it's going to be a coin flip day where the market's up or down, but everyone's long. So you have to understand that when you're managing this.
Yeah, I think that's right. And also, on the other hand, if you go to most of the futures customers who currently use systems like Trading Technologies to connect themselves to executing venues in Chicago, their average deposit is $50,000 rather than in the US the average retail forex customers deposit $6,600, and in the rest of the world it's $3,800. So if you've got an exchange traded system with multi-asset capability, the average deposit per customer is $50,000. It's a loyal, long-term, sustainable customer base without having to keep spending $1,000 to try and find new customers all the time. So if there's a possibility of having an MT5 connected to an exchange and a good risk management system behind it, which instills confidence into the customer, this is probably good for brokerages.
Yeah, definitely, and that's really where we come in with our technology. The beauty of MT5, and again, I have to emphasize that they're going to get there. There's functionality that they're going to be adding in upcoming releases that will get them there. But the beauty is, for the last 10 years, there's been a battle of off-exchange versus on-exchange.
Yes, there has.
And the two have been butting heads, and everyone's got their expert opinion as to what's going to happen 10 years from now. Is everything going to be on-exchange? I don't think everything will be off-exchange, but MT5, in a perfect world, in my opinion, MT5 or any other multi-asset platform allows a broker to offer, let's say, FX, CFDs on the major indices, maybe CFDs on equities or maybe direct equities, futures, and you've got that blend where you can manage the FX and the major indices, CFDs off exchange.
Yes, that makes sense.
And you can offer the futures and stocks on exchange, and it gives the retail audience that blend, and it's really a perfect product.
Yeah, that's right, and I think it also will attract not only a more long-standing customer, but also reduce the cost to a broker, because a lot of retail, especially smaller retail brokers, they have got a massive customer acquisition cost. Whereas if you've got an exchange-traded system which is properly managed and there's the exposure is managed properly, and a different type of customer base with a larger deposit, then even a small brokerage can compete like that, because there's a central clearing counterparty. So it doesn't necessarily matter really who the brokerage is, because they're not doing any of the execution.
Yeah, you're absolutely right. And I think that we'll get there. You know, there's a couple things I'd like to see in MT5. Number one, you can't fully cash fund stock positions and have leverage on, let's say, FX positions or CFD positions in the same account.
Right.
Yes. I think that that's a release that will come. And then options, not binary options, but proper options.
Like FX options, yes, exactly.
Yeah, that's something that's important to my team. I've got a full options market making team on my desk here.
Right.
And we're managing flow on other platforms currently that offer options. And it's incredible. I mean, if you look at an option versus an FX position, brokers can make $400 per million market making on options versus, you know, right now it's a tenth of that, if they're handling their risk okay in FX or CFDs.
Yes, yeah, that's right. So it is a remarkable opportunity with less exposure, less risk of exposure.
Yeah, oh yeah, absolutely. A lot less risk. You know, your returns on offering options, if they're market made, are very, very sustainable, and they don't fluctuate. Your volatility in earnings is quite low.
That's
yet
right.
Your P&L per million is, you know, you can achieve 400 quite easily.
Yeah, and this is actually a very, this brings me on to a very, very hot subject today, which is Britain's Financial Conduct Authority, which has now made a new ruling which will come into place. So they haven't actually put a date on it, but it's going to come into place, which will provide a huge amount of new criteria for offering contracts for difference, CFDs, through electronic platforms. And what happened was the FCA launched this particular consultation paper this morning saying they're going to put in leverage caps as well as a series of about 7 or 8 criteria that brokerages in Britain must adhere to. Now, given that most of them are OTC, CFD orientated, it collapsed all their share prices because confidence in this went right the way down. So maybe what we discussed previously in terms of having an options or a kind of futures contract, which is a bit like that but on exchange, might mitigate that problem.
Yeah, I mean, options are an amazing product because you can offer them, and traders, they have to understand options. It's not like binary, you know, pull the slot machine, mess around. It's options are a product that you have to be a little more sophisticated to understand them.
Yes.
But you can structure an outcome however you see fit. You can structure you know, if my view is 2 months from now the market's going to hit its high and then collapse, I can structure an efficient package of options, put them together, and really illustrate that outcome and profit off of that. The other nice thing is managing risk internally for a broker. Many times options are a cheaper alternative than, you know, 1-for-1 in the spot market. So there's a lot of flexibility that options offer brokers.
Yeah, that's absolutely right. And I think with the central exchange in place and so forth, it's less likely that a regulator might put stipulations on a broker that could cause them to have a serious problem with their core business product.
Right.
So
yeah, I totally agree.
That's the thing. So excellent, very interesting indeed. I'm very much looking forward to seeing how that works out, as well as your new products. I'll be following that absolutely very closely. Very nice to speak to you, Jeff. Thank you very much for joining us.
Yeah, thank you very much, Andrew. And I just want to mention your show in London that you had a couple of weeks ago. It was a really good turnout, and I appreciated you having us there.
It was great to see you there. Thank you very much indeed, and see you soon. Obviously, we'll be hosting that every quarter, so hopefully see you there again soon.
Oh, I'll be there, for sure.
Thank you very much. Nice to see you, Jeff. That's Jeff Wilkins, Managing Director at Think Liquidity in Grand Rapids, Michigan. This is Finance Feeds Podcast, Episode 6. Join us again next time. Thank you for listening. Goodbye.